Hello, everybody, and welcome to the Sense of Security podcast. Today, we're discussing holiday spending trends, consumer reports, and the January effect. So, luckily, we're here with Investmentors James Yentry to talk all about it. Welcome, James.
Hey, how's it going, Mary?
From a financial perspective, what does this year's holiday spending tell us about consumer confidence and the broader economy?
The data picture seems a bit mixed. On one hand, consumers are spending near record amounts, about $890 per person, according to the National Retail Federation, which she pointed out is the second highest on record. That really suggests underlying resilience. But then on the other hand, you have Deloitte, which found an average spending down 10% year over year, which tends to signal caution. What that really telling about how people are spending when 89% are deal hunting and 73% are regifting. So if you see that trend coming around the holidays that you gave your aunt one time, it's a strategic adoption, we'll call it, rather than an economic burden. Consumers aren't really retreating from the economy. They're demanding more value for every dollar. This reflects persistent inflation fatigue and economic uncertainty, but it's also savvy financial behavior. People are spending, but they're just being more careful about it.
So, are the budgets tightening or are they reallocating spending in a way that signals different financial priorities?
So it's definitely reallocation more than sheer austerity. The main shift towards experience over physical goods is going to be key here. This has been building up for years, but it's really accelerated over the post-pandemic. Economically, this makes sense. Experiences provide more lasting satisfaction per dollar, and they're less susceptible for buyer's remorse. If you take your family to the trip in Colorado for the winter, you're not going to really regret that. But if you buy a car, you might have buyer's remorse immediately. 7% are switching over to lower price brands, really tightening the belt. Most consumers are playing a more sophisticated game by shopping earlier to capture the deals, using pay now, buy later methods, which are in itself inherently risky. They're prioritizing what matters, whether it's travel gatherings or specific meaningful gifts, as opposed to the fluff that we were accustomed to. It's more budget optimization, I would say, rather than desperation.
Which sectors are looking good right now?
So you can classify it into two different categories. We can call it winners and losers. So winners are going to be discount retailers. Consumers are actively trading down benefits, Walmart's, Costco's, off-price stores. Travel and hospitality will continue to be winning around this time of year, especially to continue the whole experience. Spending tech, specifically small electronics and appliances, have benefit. Usually these categories are genuinely discounted during the holidays, not these fugazis, oh, buy this, but it was the same price before. But on the other token, you have the losers. Premium and luxury retailers without compelling value prop, and more mid-tier department stores tend to get squeezed. They're neither cheap nor special, we'll call it, enough. Traditional toy retailers may face price pressures, like you're thinking the high-end custom toy manufacturers. And frankly, any sector relying on impulse purchase when 89% of consumers are comparison shopping. So they're probably going to the store and then looking it up on Amazon to see if they can get a better deal. More or less, the broader shift is retailers with dynamic purchasing and loyalty programs. These are going to be the winners, rather than those who stuck to traditional seasonal pricing models that tend to struggle.
What's so interesting to me is one of the things that came up is that retail prices, they seem to jack those up and then they say, okay, now this is 40% off, right? If you're at the mall. And it's like they just manipulate the pricing so much. And then you think, oh, I'm getting a really good deal here. And sometimes there are really good deals, especially if you're doing like last minute shopping at a brick and mortar.
Yeah, absolutely.
All right. So which type of products tend to see deeper discounts or pricing changes in January or February?
I would say likely fitness equipment, believe it or not, massive discounts in late January because you start to have the taper off. People are very motivated at the beginning of the year. The New Year's resolution enthusiasm wanes, and then retailers are trying to clear inventory. Winter clothing goes on discounts. Last year's tech, they're dropping newer models, usually in Q1. New versions tend to be released at CES in January. Those are going to have heavy discounts. Furniture and mattress places will often see steeper discounts, usually around President's Day. So think February. Holiday decorations obviously plummet after Christmas. They're not really buying holiday decorations in March or February. If it's not done, since then retailers traditionally hold excess inventory post holidays, just wait. You're at that point in time leveraging the need to clear the stock, and if you can wait them out, they have more of an urgency to get it than you need it. But if it's something you genuinely need or will bring holiday or value to you during the holiday season, don't optimize away your own utility by waiting for what would be effectively a marginal savings.
So, what is this January effect anyway?
So this was something that was, I believe it was discovered by actually an investment banker in 1942. They started to really track it. But the January effect is a market anomaly where stocks, and especially small caps, have historically shown higher returns in January compared to the other months. It was first documented back years ago and then became common knowledge. But the traditional explanation usually involves several factors: tax loss harvesting, where investors are selling off losing positions for tax benefits, then buying back into the market in January.
Okay, so we're coming to the end of the year, and how should everyday investors think about for the start of this coming year?
I would just add that just don't plan around the January effect. It's waned over the last decade has become, or few decades, as it's become more massively adopted, and the impacts are more nominal. But instead, use January strategically for things that you can control, maximizing your IRA contributions in early years. Time in the market, again, is going to be timing the market. Rebalance your portfolio if it's drifted off of its baseline targets that you had set from the previous year. January's clean psychological break, and then review and adjust the contribution rates. If you got a raise, set up different types of allocation. The real January effect you should care about, I would say, is more behavioral. It's a natural movement for a financial reset and a renewed sense of discipline. Use that psychological momentum for smart, systematic investing habits, and not necessarily chasing anomalies that sophisticated markets have already pretty much priced away. And then stay consistent, stay diversified, and let compounding do its work regardless of the time of the month.
All right, so we're not quite in January yet. We're still in mid-December. And have you noticed how tariffs have impacted shopping at all? I know things are more expensive, and retailers are probably not trying to pawn off the tariff increases onto the consumer. But have you started to see some of that happening?
So there are some companies like Walmart is a huge proponent of absorbing as much of the tariff impact as they possibly can. They stated it in their earnings calls. They ate the tariffs within the first half of the year. They decided that, okay, going into the second half of the year, they're able to distribute or bring some of the costs back down, or like distribute some of the prices that tariffs have impacted throughout some of the products that they have, but they're still able to absolve most of the costs that are out there. But what I would say is this time of the year is going to be really interesting to see how they incorporate this with all the sales going in. The classic trick retailers try to inflate prices before the weeks. Maybe they'll bake in some tariff costs as well, and they bring back down to some normal prices. So it looks like an impressive 50% markdown when you're basically paying what it was worth all along. And then I guess some things that I would say is watch out for languages like compare ad to our original price without specifying that the price has actually changed. These psychological traps we try to anchor to a higher, more original price, and we feel like we're smart. We got the deal, even though we're paying fair market value to it. And I would assume that tariffs would be baked into the inflated numbers, and then they come back in at a fair market price that consumers think is a better deal. Yeah, but you really see a lot of good savings within some of the tech, within the tech and the appliances space. We're talking 20 to 40% off of things like laptops or kitchen
Oh, wow.
gadgets, washers and dryers, just because they're trying to like restock and re-inventory. So those things, though, have had some tariff impact. You will tend to see deep savings within those types of segments.
James, this is great. I wish you a happy holiday and all of our listeners too. And is there anything else you'd like to add before we wrap up?
I just want to wish everybody a happy holiday. You as well, Mary. Thank you for bringing me on the podcast as a regular contributor, and I look forward to the next time.
Yes, we're coming up to January, so we'll have to come up with some good topics. And folks, I always forget to say this, but if you have any ideas or you want to hear about different topics, let us know. Send us a note. All right. Thank you very much.
Thank you. Happy holidays, Mary.
Happy holidays.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Tax loss harvesting involves selling investments at a loss to offset capital gains, which carries inherent risks, including potential loss of principal and market volatility. There is no guarantee that tax loss harvesting will achieve desired tax benefits or investment outcomes. Interactive Brokers does not provide tax advice, does not make representations regarding the particular tax consequences of any investments, and cannot assist clients with tax filings. Investors should consult with their tax professional about the tax implications of any investment. The information in this podcast does not constitute tax advice and cannot be used by the recipient or any other taxpayer to avoid penalties under any federal, state, local or other tax statutes or regulations, or to resolve any tax issue. IBKR Investmentor is a service of Interactive Academy LLC, an affiliate of IB LLC and majority owned by IBG LLC. All content provided by IBKR Investmentor is for informational and educational purposes only and should not be interpreted as implying any sponsorship, partnership, endorsement, recommendation, or approval by IB LLC or its affiliates.